Hello traders, welcome back to the Corrective Trading Strategy course. In today's video, we're going to be talking about something quite important, something that we all talk about often on the Discord channel, but I wanted to make it super clear for everyone. And that is the different variations of the corrective setup that can occur. As we talk about in the channel a lot, we're looking either to take a rejection entry or a CT entry, and we have different targets depending on where the retracement has occurred. But I just wanted to make this clear for everyone in today's video, just to clarify any questions anyone may have and just to solidify our knowledge of the trading strategy. So just going to draw a fib here on my trading view. Now, the most common or the typical corrective trading pattern that we're trading is we're looking for that sharp impulse, we're looking for that retracement at 38.2, and then we are looking for an entry at rejection with the target back down. Now this is our bread and butter trade. It doesn't have the best risk reward of all the entries, but it works. It's probably the most, I'd say, the most probable trade that we take. One of highest probability. It just works well. The numbers work well. The 1272 level, generally speaking, it's a good measurement to measure liquidity above a high, where liquidity is. And it's the first level that acts as that rejection. That's why we call it the rejection level. It's the first level of sensitivity above a high, where in this area we normally get that reaction. So this is our bread and butter trade. If we just look at a long position or short position in this example, we're not getting incredible risk reward, but we're getting good enough. 1.6, 1.5, 1.7, depending on how much room you decide to give your stop. There's a certain level here we might want to give a bit more room. If we're in big levels here already, we might be a little bit tighter above that 38.2. But generally speaking, I like to give myself room just to avoid getting stopped out in those scenarios. So this is our bread and butter trade. That's a 1.6 risk to reward. Now, if we continue and we were to go along here, we have another type of scenario that can occur, and that is the 30.9 trade. So we come into that 30.9 level, and in this case we want to be selling higher. Just from all the research I've done, if it trades 30.9, it's much more likely to reach the counter trend level. So in this case, we don't want to bother selling at rejection if we know it's most likely going to go there. And because it retraces 30.9, it shows that the initial impulse is quite strong. Sometimes these moves, they can blow out a little bit more. So we want to be aware of that. So this trade gives us slightly better risk to reward, I'd say. Let's take a look at that in this example. It's, we're going to have a tighter stop. So yeah, we got a decent risk to reward on these trades. 2.8 on average. It's going to be roughly the same each time because we're always working with the same percentages. And these are nice trades, but we need to be wary of, I'd say you have a higher probability of being stopped out. Your stop is smaller. Also, when the move occurs, when this trading setup occurs, sometimes it's the result of a very strong trend, or we need to be wary of if we're on a lower time frame and this happens too fast, then maybe we're measuring the impulse too early, and this impulse is occurring on a higher time frame. I don't want to confuse you there, but just to say we've spotted this impulse on a 5-minute chart and it retraced down and kept going, and then we sold here. There can sometimes be scenarios where this whole move from here to here is actually just an impulse happening maybe on a 15-minute or a 30-minute chart, and we're just trying to preempt it too early. And I've seen that's happened to some of our traders before in the past, including myself. But more on that in another video. We're going to talk about filtering trades. But for now, I just want to tell you about the different types of entries that we're looking at. So that's the second one. Now, if we look at the third one, that is when we have a deeper retrace. So we're going to have a rally, an impulse. We're going to retrace 50%, and then we're going to be looking to take an entry at the counter trend, and then we're going to trade it back down to that 50% level. So this is the one with the greatest risk to reward. As we can see here, we're having we're having a 3.7 to 1 risk reward trade here. So this is our range: 1.6, 2.678, 3.7, 3.8. That's the kind of range we're having. These trades, they can be fantastic trades. Again, they maybe don't have as high probability as the standard corrective trade. Just the research shows that when we retrace 50%, we will go that little bit more further. Sometimes it will come all the way to that 30.2 level. But if we can just collect 2, 3, 4, 5 of these trades a month, they really do increase our risk reward. I'm not saying I take them every time. Again, these ones, they have a lower probability. So in order for me to take this trade, they really need to be good structure. It needs to have all my checklists ready. It needs to be some levels in here, some decent levels and areas of liquidity, and using other things, maybe the divergence, market profile, VWAP. There's many other things that we can use to overlay, again, which I will talk about in the video about filtering. But these are the 3 trades. Again, we're catching various different amounts of risk to reward. This is our bread and butter. This is going to perform. It does perform over time. It's going to do well. It's going to bring in the trades. You will have some losses. You will have some wins. That will keep you profit. But then these other trades, they can really boost your money. But for the end of the month, they can really boost your risk reward overall over a track record, over a trading period. So we need to be aware of them as well. And we need to be aware of the scenarios. So I hope this video was helpful. Again, any questions on this, get me in the Discord or put it in the chat, and we will all discuss it. But these are the 3 setups that we're looking at. Again, varying risk to reward, but we need to be aware of them. We need to look for them on the chart.